Hello there traders, my name is Elizaveta Belugina. I'm the head of analytical department at MPS, and today we start our weekly webinar on the outlook for the major Forex currency pairs. Here is my presentation. So let's begin. We'll talk about the market's positioning, about the main economic events which lie ahead. We'll cover technical analysis for Forex measures, and by the end of the presentation, I'll give my trade ideas and share my view of what is going to happen with the main Forex currency pairs during the next 5 or 4 days. Let's start our talk with commitments of traders data from CFTC, Commodity Futures Trading Commission. I review this data every week before planning my weekly strategy, as I think that these figures allow us to see some important Forex market trends. And last time we were talking about the fact that the market is turning more and more negative on the US dollar. And we can see that the overall US dollar net bullish position continued to decline during the week, which ended on Tuesday, January 31st. All in all, we can say that this US dollar bullish sentiment is now at the lowest levels since November, and there may be actually a top in the market's bullish position on the US dollar. If we have a look at the dynamics of other currencies, we can see that most currency contracts saw net positioning decline in the past week. The only notable increases were in Swiss franc and in gold. And this shows us that the market has a kind of mild preference for safe havens. All in all, the largest net short positions are on the euro and Japanese yen. These positions have declined a bit, but still they are outstanding. A large net short position is on the British pound as well. And if we are talking about commodity currencies, Canadian dollar, Australian dollar, and New Zealand dollar, here we don't have many positions, and all in all, the net position is small, and we can't say that there is a particular trend about these currencies. So long positions change, short positions change, but we don't see any clear trend with the overall net position for commodity currencies. So the main takeout from here is that the market is losing interest in the US dollar and is choosing safe haven bets like Swiss franc and gold. If we analyze the picture for the US dollar index in greater detail, we can see that the interest of large speculators for this currency is declining according to COT index. You can see the indexes below the US dollar index chart on this picture, and the interest of large speculators is marked by green line. It is declining, and the main buying interest for the US dollar is currently expressed by smaller speculators, and it means that the demand for the US dollar is not very strong and is not very reliable if we are talking about the longer term and medium term picture, because these small speculators aren't the main players at the market. Large speculators are the main players, and their demand for the greenback is declining. I have also made some pictures about COT index for the euro and the British pound. And if we look at the picture for the euro, we can see that here large speculators are rather positive about the single currency, while demand from smaller speculators is lower. And it actually adds credibility to the recent advance of the single currency, recent correction of the euro, which is taking place since the beginning of this year. This means that this movement of the euro to the upside is actually made by the big money, big players. I don't have here a chart of the open interest for the European currency, but it is not rising. It has a more neutral bias, the open interest for the euro. And this is why the euros journey north, it's euros to the is journey to the upside is kind of complicated, and the euro faces a lot of obstacles on its way up, because we don't see many new money flowing into the single currency. It's more of rearrangement of some current positions of those who already are at this market, and as no new money, no big deal of new money arrives here into the euro, we don't see a strong, rapid trend of euro strengthening. So for now, we can expect that the single currency will find support on its pullbacks to the downside. We can expect that the large players will make attempts to buy the euro and push the exchange rate a bit higher, but we don't think that this bullish movement in the euro dollar is going to accelerate. For now, we don't have such picture from this COT sentiment and the actions of the large speculators. And it's of course interesting to have a look at the COT index for the British pound. Here, the most bullish players are small speculators, while large speculators kind of fall behind these smaller ones. So this is why we don't see excessive bullish momentum in British pound, because large speculators are not really sure that this movement to the upside is going to be sustainable. And we can look, and I think that they should look definitely, at the daily chart of the US dollar index. We can say that American currency has been having a hard time recently because of Donald Trump. It seems that the new US president and his administration are eager to pull the greenback down with their verbal interventions. Firstly, we have heard that Trump said that the US dollar was too strong versus the Chinese yuan on January 19th. And just last week, Peter Navarro, director of White House Trade Council, spoke about the euro's exchange rate being too low versus the US dollar, and thus the US dollar being too expensive against the euro. It seems that the US authorities are using their position in order to talk down the US dollar. Of course, this is a kind of attempt of the US authorities, but we can understand why they want to have lower US dollar, and we can see that they are kind of testing their ability to talk the currency down. I think that the approach of the US administration is, if we can say something that will bring our currency down to a more comfortable level for the US companies, then why not do this? We have to make these commands just because we can. It seems like this is the approach of Trump's administration, and we can certainly see that there is further potential for the US dollar to weaken on such a strategy. Although we can say that traders are no longer sure that Trump will deliver his fiscal stimulus plan, and consequently that Trump's action will make the Federal Reserve raise rates and make the US dollar strengthen. The Federal Reserve has also become more cautious. There was a meeting of the central bank, the first meeting in 2017, which took place last week. And although market players hadn't expected any changes at this meeting, they still had been looking for a more hawkish statement from the Fed. And the fact that the US central bank didn't deliver this hawkish statement didn't bode well for the greenback, and it was a week of losses for the US currency. In addition, we saw that US economy added 227,000 jobs in January. It was a non-farm payrolls or NFP release, and this is surely more than analysts expected. The consensus forecast was around 170,000. However, not everything was so bright. American unemployment rate increased from 4.7% to 4.8%, and what is more important, average earnings rose by only 0.1% versus the forecast of 0.3%. Such slow dynamics of the average earnings means that the US inflation isn't as high after all, and the fact that inflation, that the amount of price growth is falling behind, is slowing down, surely makes traders expect less from Federal Reserve, expect fewer rate hikes this year, and this is a negative factor for the US dollar. US dollar index had its longest run of weekly losses since 2010. It slid to 11-week low, and the asset is now trading below the 50-day moving average. Here it is. This 50-day moving average is located at 101.40, and it has started to slope to the downside. US dollar index, however, found some support at the 100-day moving average around 99.60, and ahead of 99.25. This is 38.2% Fibonacci of May-January advance. Although technical picture for the US dollar is gradually changing to the worst, and if we see decline below 99 points for the US dollar index, it will open the way down for a deeper decline, targeting levels like 97.80 and 97.40. We can see this support line drawn for the US dollar index since May through May and September minimums, and this is where we will target the US dollar index if it falls below support around 99 mark. We have already talked about the fact that there was significant support for the US dollar index around 100.50, 100, and we saw that the US dollar settled at levels below those levels I have mentioned. So it is perfectly reasonable to expect further pressure on the US currency from both technical point of view and from the fundamental point of view because of all the concerns which are linked to Donald Trump, and also because of the more cautious approach of the US Federal Reserve. This week won't be as intense as the past week in terms of the economic data coming from the United States. We should watch the release of the US trade balance on Tuesday, I'm sorry. Crude oil inventories on Wednesday, unemployment claims, and the speech of FOMC member Evans on Thursday, and consumer sentiment and import prices on Friday. So this is the agenda for America. I don't think that this data will have a big impact on the currency. Probably Donald Trump and his various decisions will be in the market's focus. So this is a bit more difficult for traders because we don't have a schedule of Donald Trump's remarks and they are more difficult to predict. But this is what we'll have to work with these next days. Other events which are important for other currencies include the meeting of the Reserve Bank of Australia on Tuesday, Canadian trade balance data. Also, we have the economic forecast from the European Union, the meeting and press conference of the Reserve Bank of New Zealand on Wednesday. Bank of England's Governor Mark Carney speaking on Thursday, and some further releases on Friday. Let's now switch to the charts, and I'll share the fundamentals for other currencies as we are having a look at the charts, because I think that it should be more interesting and more visual this way. So we start with euro dollar, and the fundamentals for the euro are the following. Eurozone's growth outpaced the US for the first time since the 2008 global financial crisis. According to the data released during the past week, the region's GDP added 1.7% in 2016. Earlier, it was reported that American economic growth last year accounted for 1.6%. Meanwhile, euro area's consumer inflation accelerated from 1.1% in December to 1.8% in January. And inflation actually approached the European Central Bank's target of close but below 2%. The increase was caused mainly by higher energy prices. However, we can see that the European Central Bank has denied calls to start tightening its monetary policy, although some members have expressed thoughts that the time to consider the so-called tapering of quantitative easing program is coming closer. Today we will hear more from the ECB President Mario Draghi. He will likely underline that there is the environment of high political uncertainty for the euro area, that inflation expectations are still firmly anchored, and he will try to downplay this recent spike in inflation as he did at the last press conference. We can see that although there were some positive data news from the euro area, there are some negative factors for the single currency as well, and primarily these negative factors are political factors, political uncertainty, which comes in first place from France, where the leading presidential candidate, François Fillon, got involved in a scandal. And as a result, the risk of better results for the National France candidate, Marine Le Pen, who wants France to leave the euro area, has increased. So we'll likely see further pressure on the euro from this source, we can see that the markets are increasing the risk premium for France. And despite the fact that Fillon is trying to fight, he is not willing to step down as the Republican candidate. Still, the markets have a negative view of the risks and of the political picture of the euro. This is why we can see the sudden pressure on the European currency. This is the weekly chart, and technically we can see that the euro dollar managed to close last week in a positive territory around 107.80 after initial drop to 106.18. And this fact is positive. However, if we have a look at the daily chart, we can see that euro dollar faced significant resistance in the area of 108.30. Here we have the top of the daily Ishimoku cloud. In addition, if we make Fibonacci levels here, Fibonacci from the high reached in May 2016 to the minimums of December 2016, we can see that it is a resistance formed by 38.2 Fibonacci retracement level as well. So when we have confluence of different resistance levels, surely it strengthens this resistance. Here is also the upper Bollinger Band of the daily chart. MACD indicator is declining. We have a negative signal from stochastic oscillator on the daily chart as well, and this leads the single currency to test lower levels. What else do we have here? We have here the decline in 100-day moving average, and actually during the last 5 days, euro dollar didn't manage to close above this line. This line has already acted as a resistance for the single currency back in November. So this is why this price action of the euro dollar may mean that the single currency is going to dive lower before it has any chance to continue its way to the upside. Levels to watch on the downside include 106.80 mark. We can also draw a support line here. Here it is, support line from the minimums of January and February, and it will be somewhere well around 106.80 as well. So yes, to be more precise on the 4-hour chart, support levels were around 107, 106.80. Further support is at 106.40. And then on the 4-hour chart, we have 200 pivot moving average at 106 mark. These are levels we will be targeting on the downside this week. Also, I'd like to make you look at the weekly pivot levels. This is the indicator which shows us whether the single currency is situated at the positive or at the negative territory on the weekly basis, and what are the weekly support and resistance levels, which usually act as the likely targets. So euro dollar is now trading below the weekly pivot level, which is located at 107.44, and the first weekly support is at 106.59. And the second weekly support is located at 105.34. So these levels may be used as targets in your trading, in your bets against the single currency. I would recommend going long on the euro above this moving average, which is located at 107.83. And in this case, the conservative target should lie at the first weekly resistance line, which is located at 108.68. The next weekly resistance is at 109.53. And actually, I think that we shouldn't expect any increase beyond 109.53 for the euro dollar. This is where the resistance line, which can be drawn since May highs, is situated. So tops for the euro dollar around 109.50. Though I think that the main scenario we'll likely see unfold this week will be to the downside for the euro dollar. We are now seeing the currency trying to erode these support levels, and we will have a look at 107 support. All in all, we can see that the picture for the euro dollar looks, of course, very uncertain. The most important thing to look for from the technical point of view is that this bullish trend remains intact. And if it is not, it will be a good bet to bet versus the euro, as there are a lot of political risks for the single currency. However, if we see a kind of good reversal pattern here above the support line, then it means that the US dollar is even weaker than the euro. Whereas concerns about Trump are stronger than concerns about political future of the euro area, and that the single currency has a chance to make a kind of moderate recovery to the area of 108.68 is the conservative bullish target for this week. Let's move to the British pound. Here, firstly, a couple of words about the currency's fundamentals. Last week, GBP USD tested 1.27 mark, but quickly reversed to the downside, and this reversal came after the meeting of the Bank of England. So what happened at this meeting, which made investors sell the British pound and which made this daily bearish engulfing candle appear on the chart? Well, the regulator made no changes to its policy and held interest rate unchanged at the historic low of 0.25%, and also it maintained bond purchases. The central bank actually revised upwards its economic growth forecast for 2017 from 1.4% to 2.0%. Now it is clear that so far Brexit didn't affect the United Kingdom very hard, and that GBP bulls were disappointed that Bank of England's Governor Mark Carney didn't sound very hawkish, and that he didn't confirm that the next move of the Bank of England would be to tighten policy. According to Carney, the central bank will act in line with economic data and may either tighten or loosen its policy. British PMIs released last week were a bit lower than expected, though still solid. And at the same time, the country is getting closer to starting Brexit. The majority of the members of parliament voted in favor of the government's Brexit bill at the second reading in the House of Commons. This bill will allow the Prime Minister to invoke Article 50 of the European Union treaties and formally start Brexit. Third reading and the bill's final common stage is already scheduled on Wednesday, February 8th. This will be the final chance for the MPs to say that they approve the bill before it passes to the House of Lords. There the stages are repeated. Apart from this and the manufacturing production release on Friday, the UK economic calendar doesn't look very interesting. So the main idea here, to put it simpler, is the lack of hawkish commands from the Bank of England, and also the fact that Brexit looks inevitable from this point, despite some quarrels between the UK government and the UK Parliament. And this is why large players, large speculators don't think that what we are seeing now in British pound is a big reversal to the upside. If we look at the chart, we can see that GBP USD traded above 50-day moving average at 1.2425 since January 21st, and this line actually twice acted as resistance for the British currency. Then it used to be a support, and it will all depend on whether the pound will be able to stay above this line this week. I think that the risks have now switched to the downside. You can see daily MACD indicator declining and daily stochastic indicator getting lower as well. This bearish engulfing on the daily chart and the big bearish candle will act as the technical source of pressure on the British pound. It showed that the bears are very eager to not to let the bulls above 1.27 mark, and I think that this reversal to the downside from 1.27 will be able to give the British pound enough bearish momentum to get below 1.2430. If this scenario comes true, then we will target such levels on the downside as 1.2345. Next level will be 1.23. And the final target will be at 1.2260. Here they are, these levels. We can see that if we take Fibonacci from the recent advance, there is 50% Fib retracement around 1.2345 and 1.2260 is 61.8% Fib retracement. So there will be a kind of double top in the British pound, and we'll see the swing to the downside also in the area of 1.2260. There were support levels at the beginning, at the second part of January. I'm sorry. So these are the levels will be watched on the downside for the British pound. Resistance is located around 1.2525 and 1.2550 ahead of the levels we have already talked about at 1.27. Next currency pair to analyze is surely the US dollar Japanese yen. We can see that after consolidation between 115.50, this is a resistance level. Let's make it red. After consolidation, the pair is actively testing levels below 112.35. This is Fibonacci level, and this is the area of the recent lows. And decline below 112 will lead to the pairs falling towards 110.10, 110, and 38.2% Fibonacci at 109.20. It's a very interesting situation about what is happening in Japan. The yen has strengthened in the course of past week, mainly on the weakness of the US dollar. And the Bank of Japan had a really hard job. It refused to change its monetary policy stance on Tuesday, and it remained fairly committed to its yield curve control target. On Friday, it worked up a sweat to fulfill its pledge to keep yields at targeted levels. And market participants believe that the central bank will continue buying a limited amount of bonds to reach its 2% inflation target. So we can expect that there will be many ups and downs ahead, with investors rushing into selling the US dollar on the risk-averse sentiment, and the Bank of Japan's officials striving to devaluate the yen with their bond purchases. So we have this downside scenario for dollar yen in mind, but we think that its way to the downside will be bumpy because of the actions of the Bank of Japan. This week, US dollar will continue to be the main driver of the pair. Traders should focus on the US trade balance data, US labor market figures, and probably one of the biggest events of the week will be the meeting of the US President Donald Trump and Japan's Prime Minister Abe, which is scheduled for February the 10th. It's Friday. According to many analysts, it should bring some gains to the US dollar in the meeting. Probably Japan will try to be friendly with Trump and unveil some plans to invest in the United States. This will be beneficial for the US dollar. But if in case Trump and Abe are unable to produce a kind of consensus, a kind of feeling of mutual respect and cooperation between the US and Japan, then we'll likely see Japanese yen strengthen on the market's risk aversion. Towards the end of the week, market participants will be waiting for US unemployment claims and preliminary consumer sentiment index published by the University of Michigan. So we won't see any significant market moving events from Japan. The weekly chart shows us that the pair closed below 100-week moving average around 114.38. This is now the main resistance for this week. on the upside, and let's wait for some confirmation that the pair has broken below 112.35 to target lower levels for this pair. Yeah, here is the daily chart with Ishimoku cloud here. We can see that dollar yen is in the middle of the Ishimoku cloud on the daily chart, and it commonly happens that once the pair has reached the middle of the cloud, it continues its way to the opposite border of this cloud, and in this case we are talking about levels in the area of 109.87. There were many negative forecasts for dollar yen, the long-term forecast, like the forecast from Mr. Yen, Mr. Sakakiwara, who is familiar with the Bank of Japan's policy. And he also says that Donald Trump is the big risk for the US dollar, that markets will be risk averse because of his policy, and this will make yen strengthen. I think that the current situation offers us good risk-reward ratio to sell the US dollar versus Japanese yen, with targets around the bottom of the daily Shimoku cloud, around 109.93. And we can also look at the weekly pivot levels for this pair, applying the pivot point multi-time frame indicator for MT4, and here are the levels proposed by the program. They point at support at 111.44 and 110.29, while resistance is at 113.20 and 114.33. So it doesn't really matter what levels you choose. The picture looks more negative for the dollar yen. Probably we can draw the trend line here as well. Significant resistance is in the area of 114 for this currency. And finally, we have arrived to Australian dollar US dollar currency pair. Australian dollar swung to 0.7695. This is an almost 3-month high. In the course of past week, on the record trade surplus that was 50% larger than any previous update. Australian trade was helped by surging raw material prices, and these gains may be used to repay debt to protect Australia's AAA credit rating, or to increase spending to revive the economic activity. So we can see the positive dynamics of Australian currency. Towards the end of the week, NAB quarterly business confidence report will be a major market trigger. Any signs of rebound in the business sentiment will work for Australian dollar's benefit. On Thursday, RBA's Governor Philip Lowe is due to deliver his speech, in which he will probably acknowledge the signs that Australian economic growth has recently picked up. And the policy of the Reserve Bank of Australia may reflect some improvements in the economic picture for Australia. So we can see that 100-day and 200-day moving average are close together in the area of 0.75. This is support. 50-day moving average is more bias to the upside than these other two lines. We can still note that it seems that Australian dollar has run high a bit ahead of the technical picture, and that correction is likely to the area of 0.76. This is the main support, and probably even to 0.75 before Australian dollar will be able to test higher levels. Resistance in the area of 0.77 is really strong, and we will need some really bullish commands from the Reserve Bank of Australia for Australian dollar to continue its appreciation. Otherwise, a correction to the downside is needed for Australian dollar to become more balanced. And also, let's have a quick look to the chart of gold. We were talking about the fact that the instrument is likely to return to 1,210 last week. We can see that the rebound of gold was far bigger than that. And let's have a look at where the further targets for gold should be. Gold is now testing levels above 100-day moving average at 12.25, and the odds are that the precious metal is aiming at levels around 12.48, 12.50. Such factors as the market's risk aversion, Donald Trump's policies on various fronts is making gold once again an attractive area of investment. And the fact that the Federal Reserve is in no hurry to raise interest rates also means that there are buying opportunities for gold. I think that we should wait for some favorable setup to enter the market to monitor the situation at the 4-hour chart if you don't have a bullish position here already. And in the short term, gold looks a bit overbought, so we will be looking for a correction to the area of 12.18, 12.13 in order to add to our bullish gold positions. This is it. Let's now make a conclusion of what we have talked about today. The first idea and the basic idea as this is that the market is more and more cautious about the US dollar, and US dollar bullish positions are declining, and it seems that large speculators don't favor the US currency. They are afraid of Donald Trump policies, and they see that the Federal Reserve is in no hurry to raise interest rates. This is why we are bullish on Japanese yen versus the US dollar. We are bullish on gold and on Swiss franc versus the US dollar as well. At the same time, such currencies as the euro has unique setup versus the US dollar. Euro has its own political problems and has its own source of negative pressure. So the euro is vulnerable to test support at 107 and below 107, 106.80, below 106.80 will target 106. Still, given the general weakness of the US dollar, we think that the Declines of the euro should be more limited, and if the pair manages to hold above 107, then our level to target will lie at 108, 108.30, and 108.67. British pound is under pressure because the markets understand that Brexit is inevitable, and the Bank of England is not very eager to raise interest rates and admit that its policy has been too loose. So below 1.2425 British pound will be vulnerable for a decline to 1.2260 in the coming week. And for dollar yen below 112.35, the next big target, the next level to watch will be the bottom of the daily Shimoku cloud around 109.90. And here is also 100-day moving average. Australian dollar has increased versus the greenback March, but some correction is necessary to make the currency more balanced, and significant resistance is lying in the area of 0.77, 0.7750. So to test higher levels, we need some really reassuring comments from the Reserve Bank of Australia. This is how I see the picture for the upcoming week. I thank you very much for attention, and I'll be waiting for you next week at our weekly webinar where we'll discuss the results of the past week and outline the strategy for the next trading week. Thanks a lot for your attention. Have a good trading week, and goodbye from Elizaveta Belugina and FBS.